A CFO sits across from a customs officer, attempting a simple defense. The system was set up wrongly. The officer was furious, and the CFO had nothing else to say. This specific exchange reveals the true danger of dropping artificial intelligence into a messy finance department. If your underlying tax, SST, and transfer pricing foundations are weak to begin with, AI cannot repair them. It will only scale them. A wrong model, incorrect mapping, or flawed tax assumption does not become harmless because it sits inside a modern software interface. It simply becomes repeatable at a massive, automated scale. Right now, software vendors are positioning e-invoicing and AI as solutions for faster month-end closes, for smarter forecasting, and cleaner management dashboards. But that misreads the architecture. Electronic invoicing was engineered by tax authorities exclusively for tax visibility and enforcement, not for management convenience. This diagram shows data moving. Internal logic is forced through an e-invoicing filter, converting into structured packets flowing to a central tax node. With this inbound data, authorities instantly run pattern analysis, cross-match entities, and spot margin anomalies across your corporate group. Once this outbound pipe is active, bad internal logic becomes instantly exposed. The manual reporting delays that previously masked poor system setups are completely stripped away. This surveillance starts with the chart of accounts. While finance leaders view the ledger as a strategic tool for profitability analysis, it is actually the starting line for any tax investigation. Authorities do not begin their reviews by reading individual invoices. They scan the overarching structure of your management accounts to find where you group revenue and costs. This graphic illustrates the invisible tax exposure built into most ledgers. The visible tip shows clean management lines like operating expenses and cost of sales. But directly below the waterline, a complex web of structural tax liabilities goes completely unmanaged. Down here is where pass-through items get mixed with taxable supplies, and where related party charges are dangerously blurred into generic operating expenses. It is where bundled revenue codes hide multiple supply types, and where misclassified disbursements trigger severe SST scope mismatches. If you redesign a chart of accounts for a clean management view, but ignore current tax logic and SST scope, you have successfully built an elegant, highly visible map of your own tax risk. This gap between management reporting and tax reality is especially dangerous in transfer pricing. Transfer pricing must operate as a rigorous legal defense tool, not an annual compliance chore. A beautifully written transfer pricing story is entirely worthless if it cannot survive the cross-examination of hard operational evidence. You can see the divergence in this logic matrix. On the left, a transfer pricing narrative aligns perfectly with contracts, payroll, and margins. On the right, the narrative shatters as it contradicts the exact same evidence points, including your outbound e-invoice trails. Using artificial intelligence to rapidly draft a transfer pricing report under these conditions is hazardous. The software cannot inherently see these internal contradictions, nor can it understand the nuance of your specific ledger entries. It only works with the prompts it receives. The AI cannot determine who actually makes decisions, where commercial accountability truly sits, or how work practically moves apart from the official organizational chart. Without a human narrative rooted in factual evidence, an AI-generated document becomes a self-inflicted wound. It is a highly polished script handed directly to the authority to attack the company. AI is just a loudspeaker. It strictly amplifies whatever foundational strength or weakness is already present in your finance function. Finance leaders now face a strict binary choice regarding their systems. You can discover your structural transfer pricing gaps yourself, or you can wait for LHDN to find them for you. When that audit happens, telling the officer that the software generated the report or that the system was configured incorrectly will not shield the business. Operating in this environment requires aggressively constructing an evidence-backed transfer pricing defense well before LHDN begins their intense scrutiny. The precise mechanism to build that defense is the upcoming 3-day minimum CTPD working session, led by Dr. Choong Kwai Fatt in July 2026. This environment is exclusive and highly technical. It is engineered strictly for CFOs, finance directors, tax managers, and firm partners who require practical implementation. The exchange is simple. You bring your raw group structures and related party data to the session. You leave with a hardened, near-complete contemporaneous transfer pricing documentation draft engineered specifically for YA 2025.
To fully de-risk the final output, the company can also go for the add-on option of have your draft transfer pricing document personally reviewed and commented on by Dr. Choong, ensuring your narrative is sufficient to match your operational evidence.
For finance leaders who prefer to identify their blind spots before LHDN does, the time to prepare is right now. Search for Synergy TAS Plus or visit the link provided to secure your place in the working session.